Forget everything you've heard about credit scores, coffee habits, or even having to cut back on the smashed avocado on toast. When a bank assesses your home loan application, none of these things are their top priority. Instead, there are only two questions that a bank truly cares about. And if you don't know what they are, your application could be doomed from the start. Today, I'm going to give you the insider view on what the banks are really looking for. Everything in the lender's credit policy is about finding out answers to these questions. In fact, once you understand these two questions, the whole loan application process starts to make a whole lot more sense. So what are these magic questions? Well, in plain English, they pretty much boil down to, firstly, will the bank get their money back? It's all about the security of the loan, usually summed up as something called the loan to value ratio, or LVR. Essentially, they want to know about how risky it's going to be for the bank to lend you this money, given the value of the property. And two, can you afford to make repayments? This is about your ability to service the loan, known as serviceability in bank speak. In other words, do you have enough income and a stable enough financial situation to comfortably pay the loan back with interest? Everything the bank asks for, your pay slips, bank statements, credit history, property details, savings, feeds into one of these answers, or usually both of these questions. I'm going to take you through this process in more detail, what you need to understand if you're looking to apply, or if you're looking to build a portfolio, why the answer to these questions still matter.
Welcome to the Buying Your First Home podcast, your personal guide through the Australian housing market. Here we tackle the big questions and the small details that come up when buying your first home. From financial prep to finding the right neighbourhood, we're here to ensure that you've got all the knowledge at your fingertips. So let's take the first step towards unlocking the door to your new home.
Let's jump in. Question one, will the bank get its money back? When a bank lends you hundreds of thousands of dollars to buy a home, the number one worry is risk. Specifically, the risk of losing the money if things go wrong. So the first question the bank asks themselves is, will we get our money back? It's all about protecting the bank's interest in a worst case scenario situation. In practical terms, that boils down to the loan to value ratio, your deposit amount, and the quality of the property being used as security. Understanding loan to value ratio. Let's talk about LVR, because it's a term you're going to hear a lot of. Loan to value ratio is just a fancy way of expressing how much of your property's value you're borrowing. It's a pretty simple calculation. LVR equals loan amount divided by property value times 100%. For example, if you're buying a property valued at $500,000, you have a $100,000 deposit, so you need a $400,000 loan. The LVR is $400,000 divided by 500,000, 0.8, i.e. 80%. When the banks look at this, if you have a larger deposit, the LVR is lower and it's less risk to the bank. If you have a smaller deposit, the LVR is higher and you're kind of seen as more risk to the bank. Banks place a lot of emphasis on LVR when they're assessing your loan. Why? Because it directly affects how much they're going to lose if you don't pay back the loan and they have to repossess and sell the property. The higher the LVR, meaning the more of the property value is funded by the loan rather than your own deposit, the less cushion there is for the bank if property values fall or they need to sell quickly. Think of it from the bank's perspective. If you've only put down a 5% deposit, so you're borrowing a 95% loan, and the housing market dips slightly, the property might no longer be worth what you owe. In a worst case scenario where the bank has to sell the house, there's a real risk that they might not get all their money back after paying the selling costs and any market losses. That's a nightmare scenario to them. On the other hand, if you contributed 20% deposit, so you've got an 80% LVR, there's way more buffer. Even if property values drop, the sale of the house would likely cover the remaining loan. So the lower the LVR means the lower the risk to the lender, and banks like that. The bank's question, will we get our money back, is really about managing collateral risk. When the lender looks at your application, the property and the loan amount are really the first thing they look at. Some things that banks want to ask about your security or your property is, how much is the property worth, really? Doesn't matter if you think you're getting the deal of the century, the banks will still do their own valuation of the property, and sometimes they might be a bit more conservative than what you're actually paying. The bank's job here is to make sure that the property value isn't inflated. They'll ask, if we had to sell this home today, what could we realistically get back for it? This is why, and we don't see it often, but sometimes a bank valuation comes in lower than your purchase price. The bank and the valuer are being cautious because it's their money on the line too. Where is the property located and what type is it? Location and property type can affect how easily it can be sold. Is your property in a big city with a liquid market or a remote area with a few buyers? Is it a standard house or unusual property, like a small studio or a rural property with heaps of land? Banks have policies on all kinds of properties they'll accept as a security. For example, a lot of lenders have restrictions on apartments below a certain size, often under 40 square meters, or properties that they consider in high-risk postcodes or volatile areas. This can be mining towns or some regional areas. They're essentially asking, how easy would it be to sell this property if we needed to? A house in a desirable suburb is easier to offload than a specialty property in an area with low demand. What is the LVR? As I mentioned earlier, this is a core metric when the banks are assessing your application. The higher the LVR, the riskier it is for the bank. Every bank has its own LVR limits. Generally in Australia, most lenders consider anything above 80% LVR a higher risk loan, Very few will lend 100% of the property value. That usually requires a guarantor or another property as security. Most will lend up to 95% of the property value, often with conditions. Because of these considerations, you'll see banks do a few things when the LVR is high. Firstly, there's lender's mortgage insurance. If your LVR is above 80%, almost all lenders will require you to pay lender's mortgage insurance outside of the government home guarantee schemes, obviously. LMI, or lender's mortgage insurance, is an insurance that protects the lender, not you, in case they have to take a loss in the loan. If you default and the bank has to repossess your home and sell it, and they say make a $50,000 loss, the lender's mortgage insurer pays the bank that $50,000, and then they'll still come after you for that money, which is crazy. But in short, LMI shifts the risk of high LVR loans off the banks and onto the insurer. This is why banks are willing to approve loans above 80%, because even though there's less cushion there, the LMI covers their risk. But as I said, it doesn't protect you at all, it's there to protect the bank. The main benefit to you is it allows the bank to lend you with a smaller deposit than they'd otherwise accept. Higher interest rates for high LVR loans. Some lenders charge a slightly higher interest rate for loans with an LVR above a certain threshold. This can often be tiers between 80 to 90% might be a certain rate, 90% plus is a different rate. This is a way to compensate for the extra risk. The logic here is if you're borrowing, say, 95% of the property's value, the loan is riskier, so the banks want to make a higher return or interest on it. Not all banks do tiered pricing for LVRs, but across the industry, we do generally see better discounts or better rates for lower LVR loans if you got a 20 or 30% deposit, for example. This is rewarding borrowers for a bigger deposit. And it can be frustrating. You might see the banks, some of the big banks, Combank and Westpac do this all the time, where they're advertising a juicy, mouth-watering rate, and it's only for borrowers with a 70% or under LVR. So you need to have a 30% or more deposit, which is crazy. Additional credit requirements. At very high LVRs, so I'm talking 90% and above, some banks do put extra conditions in there. They may want to see genuine savings. That's evidence that you've saved at least 5% of the purchase price yourself, and it wasn't just a gift, which shows you've got a bit of financial discipline. They might also be stricter about your credit scores or other aspects because you have less equity than people with a 20% deposit. Some lenders even reduce the maximum loan or LVR if the property is in a location they deem risky. From the bank's point of view, it's all about layering their risk protection. Property and policies. All right, so I touched on property specifics, but now let's expand on that because this bit often surprises people. You might assume that if you got the required deposit, any property you choose is fine, provided the price is right. But banks have entire manuals, I'm talking pages and pages, of guidelines that feed into this risk question. Here's a couple examples of property-related lending policies in Australia. Location and postcode restrictions. Lenders sometimes categorize postcodes by risk. A booming capital city might be a category 1, that's the lowest risk, whereas a small town in a regional area could be a category 3 or a category 4, a high risk suburb. So if you're buying in a less typical location, be prepared for maybe needing a high deposit or shopping around for lenders that are comfortable in that area. Property type and size. Many banks won't lend on an LVR above 80% on units smaller than 40 square meters, and they often want a high deposit. Ultra small apartments have a limited buyer pool and their values can sometimes be more volatile. Similarly, specialized properties like student accommodation, service apartments, company title units can be completely off limits if you have a smaller deposit and require a higher LVR. If you're a first-time home buyer considering something like a student apartment because it's cheap, heads up, finance could be a bit risky and tricky. Also, if the property is unique, like heritage listed warehouse conversions, might only have a few comparable sales compared just to a regular 2-bedroom apartment, which then in turn mean the bank's valuer puts a conservative value on that property. Land size and usage. If you're buying acreage or a hobby farm type of property, a lot of lenders have limits on how much land site has to be. And if it's over, say, 150 acres, they may not consider it a residential property and it turns into commercial and you need a big 30% deposit to do that. At the end of the day, from the bank's perspective, it all ties back to how easy it is to sell the property and get their money back. If your property might require a specific buyer, then it's risky for the bank if they have to sell it under duress. Construction and condition. If the house is in poor condition, so it's not livable, some banks might not give you the loan until the repairs are done or require a low LVR. New construction, house and land packages, or off-the-plan units carry risk in valuations coming in under the purchase price, especially if the market shifts between when you sign it and often 2 or 3 years in the future when you settle. Banks know this and sometimes they value off-the-plan properties more conservatively if you're a few years out, or if you're getting closer to it, it can go the other way if the market's moved up a lot. Your off-the-plan property could be worth more today because you signed a contract 5 years ago. At the end of the day, the bank wants to avoid a scenario where you agree to pay $500,000 for a property today, and then in 5 years, if the market dips, if it's only worth $450,000, they're going to be underwater. So this is why if you're buying off the plan property, you can't get pre-approved. You have to wait until a month or 2 before settlement and look to apply for finance then. Off the plan properties aside, the key point here is that all properties and deposit factors are the bank's way of mitigating the risk on the collateral side, on the security on the property. Each bank has its own detailed credit risk policy addressing these, fitting their particular risk appetite. Some smaller lenders or non-bank lenders might be a bit more flexible on certain properties or higher LVRs, but often the trade-off is it's going to come with a higher interest rate or higher LMI premiums. This is where a good mortgage broker really earns their keep. From our point of view, we keep across different lender policies and which scenarios they're going to be comfortable with. But whether you go through a broker or you go to a lender directly, understanding will the bank get their money back question is largely looking at the LVR and property risk helps you make sense of some of these weird conditions that banks might throw at you. So how can you improve your position on this question, how the bank's going to get their money back? As a home buyer, there are some things you can do to help the banks feel a bit more comfortable in your situation. Save a bigger deposit. All right, it sounds obvious, but I'm just going to say it. The closer you get to that 20% deposit, the easier it gets from the bank's credit policy perspective. At a 20% deposit, 80% LVR, you eliminate the LMI and you look a lot less risky. It also simplifies the bank's policies because there are some smaller banks where they've got a certain policy up to 80%. And as I said before, from 80% above, they have the lender's mortgage insurance policy. So it changes things around that. The next step is consider First Home Guarantee Scheme or other schemes. If you qualify for the Government Home Guarantee Scheme, then you leapfrog the deposit issue. The First Home Guarantee Scheme allows a 5% deposit without lender's mortgage insurance. There are limited spots and property caps on this, so check out other videos we've got on that whole dedicated scheme. Using this Home Guarantee Scheme, though, you actually use the bank's policy under 80% LVR, so it is a bit more flexible and it's lower risk to the bank. Use a guarantor or family pledge. If you're lucky enough to have parents willing to help you go guarantor, the banks may allow a family guarantee. This is where your parents might use the equity in their home to secure part of your loan. Effectively meaning the bank could say lend you 100% the full purchase price and they put 80% of that against your home and then 20% against your property's view. That way that when the bank's assessing things, they view your portion of the loan at that 80% and there's no LMI needed. It's a great way to overcome a low deposit, but you want to make sure your parents are comfortable with this, so chat to a broker in a bit more detail on that. We've also got a bunch of videos on guarantor loans you can check out. Next up, choose your property wisely. Quirky properties like tiny apartments, rural properties, I've even seen clients try and buy converted churches, seem really cool and funky, but don't be surprised if the banks have different policies around this. Chat to your broker if you are looking at anything that's just not a standard 4-bedroom, 5-bedroom house or a unit, because the banks can have strange policies around this. The other one that's pretty common is the apartment size. So generally over 50 square meters, you're all good. Some have different policies between 40 to 50 square meters if it's including internal, balconies, car spaces, a bunch of other stuff. So speak to your broker on the specifics around that. All right, so that covers the first big question. Is the bank going to get its money back? We learned that it all comes down to the property value and the LVR you deposit and mitigating things like the lender's mortgage insurance costs. But the second question is really as important. The bank's second question is this: are you able to comfortably pay back this loan month after month, week after week without falling into hardship or missing repayments? In lender lingo, they put it down to one word: serviceability. Your capacity to service or repay the loan given your income and financial obligations. While the first question about getting the money back is about protecting the bank in case of default, the second is aimed at preventing the default in the very first place. Banks don't want to repossess your house. It's a last resort and really it's a lose-lose situation in many ways. They'd much rather lend to people who would reliably make repayments. The banks, after all, earn its interest and profit smoothly, and you keep your house and everyone's happy. So at the end of the day, the banks will go to great lengths to analyze your ability to pay the loan. What is serviceability? How banks calculate your ability to repay? In simple terms, serviceability is whether your income is enough to cover your proposed loan repayments plus all your other living expenses and costs, with a bit of a buffer safety. A common way this is expressed in the background in bank calculators is debt to service ratio, DSR, or debt to income. But at the end of the day, it's about cash flow. Money in versus money out. Can you afford the loan? Every lender will take your financial information and plug it into their own serviceability calculator. This is basically a formula that includes your income from all sources: salary, income, bonuses, overtime, commissions. I'm talking everything. Family tax benefits, you got it. Minus your expenses, living expenses, food, utilities, any regular expenses, basic living expenses. And if you think you've underestimated, the banks will use the housing expenditure measure, HEM, as a bit of a floor. Your existing debt commitments, other loan repayments you have made, such as home loans, car loans, personal loan, HECS, help student debt, or other buy now, pay later obligations. And then finally, the proposed home loan debt, the new details, the interest rate, and therefore the new monthly repayment required. They crunch these numbers to see that you've got a surplus. Essentially, they want to confirm that you're going to have money left over after paying for these obligations and everything else. They also include a 3% interest rate buffer on top, just in case interest rates go up. The interest rate buffer: can you still pay if times get tougher? One critical aspect of Australian lending practice is the interest rate buffer. Banks don't assess your ability to pay on the actual interest rate today. They assess it on a higher interest rate to create a safety margin. Right now, they add 3% to actual loan interest rate to test your borrowing capacity. So if you're looking at a home loan at 6%, the banks will actually check whether you can still comfortably make repayments at 9%. This buffer isn't just a random number that picked out of the air. It's set by APRA, the banking regulator. APRA put this 3% buffer in place back in 2021 to ensure people could still afford loans when we had super low interest rates in case the rates went up unexpectedly. Why do they do this? It's simple. The banks want confidence knowing that you'll be paying back your home loan even if interest rates shoot up or your circumstances change. It might feel frustrating if your repayments at the current rates seem totally manageable, but the bank can still knock you back. What they're trying to do is protect themselves and you, I guess, from financial stress. Income, what counts and how it's assessed. Now let's break down income, because not all income is treated equally in the eyes of the banks. Broadly speaking, banks love income that's stable, regular, and easy to verify. If your income situation is straightforward, the bank's job's easier, and they'll feel more confident you'll keep earning that money. If it's complex or variable, they're going to scrutinize it or shade it, that means to count less of it, to be safe. Here's some common types of income and how lenders view them. Salary or wages. This is your PAYG, bread and butter employment. If you're full-time or part-time employed with a steady salary, banks will typically take 100% of your base salary. Many Australians in industries like healthcare, mining, sales earn a chunk of income through overtime and bonuses. Lenders will often count this income, but not at 100% of what you earn unless it's regular and guaranteed. Typically, they might take the average of the last 3 months overtime and then use about 80% of how much you earned on that. This depends on the industry too, because if you're a nurse, a frontline healthcare worker, they can take 100%. But for example, if you earn $10,000 in overtime over the last 3 months, they'll shade that, they'll take 20% off, so then they use $8,000 in your income assessment. It's the same thing like bonus. A lot of banks, if you get an annual bonus, will want 2 years history. There's some that can consider 1. But the key thing is consistency. The banks really want to see a history, pay slips or group certificates showing year on year and showing that your ability to earn that income wasn't just a big flash in the pan, it's going to be consistent over the next few years. Casual or contract income. If you're a casual worker or on a contract, like a fixed term contract or labor hire, banks are probably less easy on your income because it's not seen as secure as a permanent role. But it's not a deal breaker. They typically want just a bit more history to prove stability. For casuals, minimum is usually 6 months in your current role, and they're pretty happy with that. If your income goes up and down, it fluctuates a lot, they may want to annualize the last 6 months' income to work out what your income is if you're casual or contractor. And if you've only been short time in the role, we can sometimes use your last 2 years worth of history to show that, well, Jayden's been in the IT industry for 2 years. He's just changed for a new contract. That's completely fine with a lot of banks too. Self-employed. This is a big one. If you run your own business or work for yourself, so in other words, if you invoice some every month and you have to pay your own tax, the banks will typically want at least 2 years tax returns or financials. It's not that banks don't like self-employed borrowers, it's just they're a bit harder to assess. Your income isn't guaranteed like an employment contract, so they compensate by digging more into your financials. If you're self-employed and a first-time home buyer, definitely chat to a broker, reach out to us, we can help out and assess your situation. Investment income. If you have an investment property, bringing in rent, dividends or shares, banks can consider that. Dividends not as much now, but it is possible. With rental income, they'll usually only count a portion of it. So they'll only use 75 to 80% of that rental income because they assume some of that rent goes towards paying agents, maintenance, vacancies, that sort of stuff. Government payments. Certain payments are accepted as income if you have kids. So for example, family tax benefits, part A and B can be counted by many lenders. If you get a pension from overseas, I've seen some people get that counted, disability pension, that sort of stuff. So it is possible, chat to a broker, not all banks will accept that. Other income like child support payments, if you get scholarship income, all this sort of stuff can be considered, but it just depends on the bank. As you can see though, reliability and consistency of income matters. The bank basically asks, how likely is it for this income to keep coming in the foreseeable future? A permanent job with a salary, that's easy as. A commission job where you get paid a commission 1 week and then it's gone for 6 months, swings wildly and makes it risky for the bank. And this is why it can be frustrating. You might hear of someone getting a loan approved really easily and someone else with the same income struggling. If the composition of that income differs, say one is a salary, some's part-time self-employed, the banks assess everyone very differently. Expenses, the underestimated side of the equation. This is where a lot of first home buyers trip up and aren't sure what to declare. Banks will generally ask you to fill out like a living expense template for things like food, transport, entertainment, insurance, that kind of thing. They'll want a monthly figure. They also look at, importantly, your existing debts and financial outgoings. There are 2 main parts of expenses in a loan assessment. Your everyday costs, like living expenses, and your debts and commitments, loans, credit cards, the like. For living costs, Australian banks typically use a benchmark called the Household Expenditure Measure, HEM, as a bit of a minimum based on your household size, if it's 2 adults, 2 kids, 1 adult, single person, that sort of thing. If your monthly living expenses are way below that, they'll default to the HEM. And if it's way above that, they're going to ask a lot of questions on what is going on there. You can Google and check out the HEM as well. And if you're a few years away from buying a house, check out your expenses from the last 3 to 6 months to see if you've got any outlying categories there and stuff you can cut back on. Now for debts. This part is often what reduces how much you can borrow and shocks people out because any existing loan or credit card limit can significantly eat in your serviceability. Here's how. Personal loans, car loans. The monthly repayment on a personal loan or car loan will reduce the available income that you have every month. So if you pay off or close your personal loans before applying for a mortgage, it can make a big difference. Credit cards. Even if you don't owe anything on the credit card, lenders assume you might use it. So they factor in a theoretical repayment. Many Australian banks assume about 3% of the credit card limit as a monthly expense. So if you have a $10,000 credit card limit, they'll count a $300 per month liability against it. If you have multiple credit cards, it can really add up. So if you have any old or unused credit cards, just consider getting rid of them now if you don't need them. HEX or help loan. A lot of people have student loans. It's just part of life. Even though it's a government and income contingent loan, there's no interest, there's indexation, banks still treat HEX as a compulsory repayment and an ongoing expense. You generally shouldn't rush to pay off your HEX just to get a loan because it's cheap debt, but at least be aware that it's potentially going to reduce your borrowing capacity and chat to your broker about what kind of difference it makes. Buy now, pay later. These are relatively new, but a lot of banks treat Afterpay Zip kind of like a credit card. So they'll look at the limit that's available, or they'll look at how much you're paying per month and reduce that from your borrowing capacity. Other regular commitments. This can include child support, medical expenses, private school fees, private health insurance. These will get factored in as almost like a liability and they reduce your borrowing capacity. When the bank tallies up all your current expenses and the new mortgage repayment buffer, they then compare it to your income. Typically, they want to see a surplus or see that at least your income covers the expenses with a certain ratio. And here's something I want to clear up. A lot of first-time buyers think, well, if I can show the bank I've been paying $500 a week in rent, the bank should know that I can pay $500 a week in a mortgage. And it's true that's good to be able to show that you're capable of making the repayments. In fact, some cases, the banks will use your rental history as evidence to not have to see genuine savings, but it doesn't help your ability to service. Rent of $2,000 a month doesn't automatically mean the bank's going to approve you for a $2,000 mortgage repayment. They need to run through their calculators, look at your expenses and make sure it all fits together. It's also worth touching on another thing here is your credit history as part of the willingness and affordability question. This ties in because even if mathematically you can afford the loan, banks also check your past credit history and behavior to make sure you're going to pay as agreed. Your credit report in Australia shows any loans, credit cards, etc. you've had and any applications you've made with any negative marks like late repayments, defaults or bankruptcies noted on there. It shows your repayment history for the last 2 years on credit accounts. This is called comprehensive credit reporting. If you have any outstanding defaults, that's unpaid debts that went to collections, or a history of frequently missed repayments, that's a pretty big red flag. A lot of lenders are going to outright decline your application with an unpaid default, or at least require it to be repaid, and some will want a bit of time to have passed since you repaid it. Why? Because the default suggests you didn't pay someone back, and why take on the risk that you might not pay you back your mortgage? Even a small default like an old phone bill can hurt. It goes to the heart of the question, will you repay as promised? Credit score. In Australia, you have a credit score from agencies like Experian, Equifax, etc. Banks do look at it, but unlike in some countries like in America, it's not the sole determinant of your interest rate or approval. It's just a piece of the puzzle. A very low credit score could get you rejected by a bank, so if it's under 650, it can be trickier. But there's also some banks that don't have an exact number. They'll look at all the other bits and pieces we've covered in this video. I will say though, if you've applied for a bunch of credit cards recently, so if you've applied for 5 different personal loans and 3 credit cards in the last 6 months, it can make a net lender nervous. They worry that you're so desperate for credit and you're taking on lots of new debt. What's actually going on in your life to cause that? Even multiple home loan inquiries in a short period can ding your score and perception. So try not to just take a shotgun approach and apply for everywhere with a home loan. Do your time, research and use a broker that's going to help you one step at a time. So in short, credit history is like a report card of your willingness and reliability to pay. The bank already covers your ability with the income and expenditure stuff, but they also want to trust you will make the mortgage a priority. If your history has some blemishes on it, you can't really hide it, but be upfront. Sometimes a good explanation, like you lost your job, you went traveling, you fell behind, can help. Especially if there's issues in the past, it was 4 or 5 years ago, you might have gone through a separation. There are banks that will willingly consider that. And worst case, there are specialist lenders like Pepper and Liberty and Latrobe that can consider your situation if your credit file is in not great shape. All right, so putting it all together, thanks for sticking through this rundown. Hopefully it hasn't been too much detail. Maybe not enough. I don't know. Let me know in the comments below. By now, you should have a clearer picture on what makes the home lending process so complex. Interestingly, at the end of the day, it boils down to 2 key questions. Can the bank get its money back if things go wrong? And can you afford the loan repayments so things don't go wrong? For Aussie first home buyers, understanding these 2 questions can be pretty empowering. Cuts through a lot of the noise and helps you know where to focus in preparing. Building a solid deposit and choosing an affordable property is going to really help answer the money question. Organizing your finances, your income, expenses, debt can help prove you can make those repayments, and hopefully you've addressed some of the misconceptions in the market. By focusing on these 2 questions, you're going to increase the chance of a smooth approval and you become a more informed borrower and not over borrow and get too stretched. If you need help with a home or finance, hit us up at huntsgallo.com.au with a home for home buyers across Australia. And if you've got any questions, leave a comment below. I read every single one. And until next time, I'll see you later.